We know that portfolios have very little gold in them. It's somewhere in the range of 0 to 1 or 0 to 2%. And most portfolios have no gold at all. But this now appears to be shifting. Some banks and some institutions are starting to come out and say that portfolios should hold a little gold. And hats off to Morgan Stanley, their chief investment officer favours a 60-20-20 portfolio strategy with gold as an inflation hedge. So basically, he's looking at moving from the traditional 60-40 approach in equities and bonds to a 60-20-20 approach where gold is one of those 20s and replaces half of the bonds. Another bank which has started to recommend gold, and there are a few others, is Standard Chartered. You may have seen has come out and said that investors should have 15% of their portfolio in gold. Whatever the correct figure is, it's clear that the current level of between 0 and 2% is just too little. It's not going to move the needle at that level. You need at least 5%, and 15 or 20% would be a more sensible number. So even if a very small percentage of global assets, that's bonds and equities, rebalances into gold, and there's 300 trillion of these assets out there, it would absorb the entire year's mining supply. How much would have to deviate from those assets into gold? 0.1%, 0.17% would absorb the entirety of the gold mine's annual production. Put it another way, that's 1 in 600 of the amount of money in assets related to gold, related to stocks and bonds. So if institutional money starts to flow into these assets, the gold price will move very quickly. Now, if you're considering buying physical gold, one option that I'd like to help try and make it easier for you is my affiliate, which is Gold Bullion Partners in the UK. They provide physical gold, competitive pricing, and you can speak to them on the telephone number below this video. If you have any doubt, look at the Google reviews on Google and you'll see what the Google reviews have got to say. I'm just pointing them out there. It's all 5-star. 104 reviews I see today. That's Gold Bullion Partners in the UK. And you can speak to them for absolutely free of charge on the telephone number below this video. Now, we've got central banks accumulating gold at a record pace. They're buying more than 1,000 tons a year for the last 3 years. And the high prices, the record prices, are just not deterring them. And let's face it, after all, they can print money as much as they like. So why would they care if the price is at an all-time record? They don't care. They just want more. So why do they want more? Why are they buying? Well, they want to diversify away from the dollar. They're hedging inflation. They're preparing for geopolitical risk. And they're increasing their resilience against unforeseen events in the world markets. Who's leading the purchases? Well, we know that mostly the big buyers are the emerging markets. They're countries like China, Turkey, India, Poland, and Kazakhstan, for example. And surveys are showing that around 81% of the emerging market reserve managers expect to increase their official gold reserves over the next 5 years. You can find the results of that survey on the World Gold Council website. Recently, we've seen places like China and Japan effectively reduce their exposure to government bonds, US government bonds that is, treasury bonds, as a percentage of their GDP. So as their GDP and the US's GDP has gone up, their exposure to gold has increased and their exposure to government bonds has effectively been decreasing. And of course, we've seen on COMEX unusually large deliveries this year. We don't know who is taking delivery because that's secret stuff, but someone somewhere is taking a lot of gold. Now let's move to a more worrying aspect. I'm going to talk about the digital euro, which is about to arrive. The digital euro will be going live next year and will be full-blown by 2027.
Let me begin by saying something that is becoming harder and harder for mainstream commentators to deny. We are entering an era where traditional portfolio theory simply no longer fits the world we are living in. For decades, financial advisors could get away with the old 60-40 split between equities and bonds, almost like it was encoded in human DNA. But the world has changed. Monetary policy has changed. Fiscal stability has changed. Geopolitics has changed. The integrity of currencies themselves has changed. And when anchors begin to shift, you inevitably see investors reaching for something they can trust. That, historically, and now, once again, is gold. And I don't mean in the vague emotional sense people often use the word trust. I mean mathematically, geopolitically, and structurally. We're at the beginning of a multi-decade repricing of gold's role in the financial system, and the early signs are already quite loud if you're paying attention. For example, the data is crystal clear. Global portfolios hold virtually no gold. When I say no gold, I don't mean a small amount. I mean that most portfolios today hold between 0% and 2% exposure to the metal, which is astonishing when you consider the magnitude of global debt, the fragility of bond markets, and the speed at which monetary supply is expanding. Yet suddenly, and this is the fascinating part, major institutions are acknowledging it. Morgan Stanley's chief investment officer, who historically has not exactly been a gold cheerleader, came out recommending a portfolio shift from the standard 60-40 to a 60-20-20 model, with gold replacing half of bond exposure. That is not a trivial adjustment. That is a tectonic acknowledgement that the bond market, the supposed risk-free anchor of the financial universe, may no longer be risk-free at all. While many investors shrug at comments like these, thinking they're just academic tweaks, the math behind them is earth-shaking. Global assets in stocks and bonds exceed $300 trillion. If even 0.17% of that capital rebalances into gold, it would absorb an entire year of global mining output. And that's not a theory. That is a simple supply-demand truth. When you have an asset whose price is set at the margin, tiny flows create massive price adjustments. If 1 in $600 sitting in global portfolios shifts into gold, the entire supply is spoken for. You don't need a rush. You don't need panic. You don't need a crisis. You just need a minor portfolio rebalance. It's like having a small nudge at the top of a mountain that starts an avalanche. And it's not just Morgan Stanley waking up. Standard Chartered has put out multiple bullish reports, and Ray Dalio, who often speaks in the language of long-term structural cycles, is publicly saying portfolios should hold 15% gold. Dalio is not the type to say things for reaction. He's methodical. He's analytical. He's the man who predicted both the Japan bond crisis and the 2008 debt unwind. He's not a YouTube analyst with a cat walking across the keyboard. He's one of the most sophisticated macro thinkers of our time. And when he says 15%, it is a signal that the monetary and debt environment we're moving into is unlike anything in the last 50 years. Now let's shift to central banks, because they are the real players behind the curtain. Individuals buy gold because it feels safe. Hedge funds buy gold because they smell momentum. But central banks buy gold because they understand the structural future of the monetary system. And what they've been doing is astonishing. Over the last 3 years, central banks have purchased more than 1,000 tons of gold annually, the largest accumulation since the end of the Bretton Woods system. These are not small purchases done in secret. These are coordinated accumulations by China, Turkey, India, Poland, Kazakhstan, Singapore, and several Gulf nations. They aren't buying ETFs. They aren't buying futures contracts. They are taking physical, delivered metal. And let me tell you something very important. High prices are not deterring them. Central banks do not care if gold is at an all-time record. Why would they? As I always say, they don't buy gold with money. They buy it with printed currency. A central bank never opens its checkbook with the same hesitation you or I have. If they want more gold, they simply create the currency and acquire it. For them, gold is an asset without counterparty risk, and in a world of rising geopolitical fractures, that characteristic becomes priceless. Now, who exactly is taking delivery on COMEX? That's a question I get often, and the truth is, we don't know. The system is intentionally opaque, but what we do know is that deliveries have surged. This is not speculative paper churn where traders flip contracts like day trading teenagers. This is someone, somewhere, quietly taking physical metal off the market. When you combine that with central bank flows, the picture becomes clear. We are witnessing a structural shift from paper gold to physical gold. And physical markets always win eventually, because they represent reality rather than leverage. Let's pause for a moment and look at the broader context. We live in a world of $300 trillion in global debt, accelerating deficits, fractured alliances, weaponized currencies, and a digital financial architecture that is becoming increasingly centralized and increasingly controlling. Against that background, central banks buying gold is not a mystery, it is self-preservation. Which brings me to something critical that deserves more attention. The digital euro, because it ties directly into gold's rising importance. The European Central Bank has made it abundantly clear. The digital euro will begin rolling out next year, and by 2027 it will be fully operational. I want all of you watching this to think long and hard about what that timeline means. The ECB isn't experimenting. They're not testing. They're not researching. They are implementing. The train has left the station. Digital currencies, unlike cash, are traceable, programmable, and centrally controlled. If a government wants you to spend your money by a certain date, they can do that. If a government wants to prohibit certain purchases, they can do that. If a government wants to adjust your spending based on your carbon score, your social behavior, or your political alignment, they can do that. And before someone says, "Oh, Clive, that sounds like conspiracy talk," let me remind you that the ECB and BIS have openly published research papers discussing the concept of selective programmability. This is not theory. This is in their own documents.